webinar, this webinar does allow you to claim SHRM credit. So once we are finished with the webinar, our team will send out the code for the SHRM credit. So with all that being said, we're going to go ahead and get started. Again, if you don't know me, my name is Mike Reardon. I lead the Benefit Ed team. I've been with the Benefit Ed team since the very beginning in 2015 when we started offering education benefits. We feel like we're unique in the space because we have a pulse on the benefits side of things with emeritus. But maybe a little bit more pertinently for today, we have a great pulse on things on the student loan side of things. So Nelnet is the largest student loan servicer in the world. They service billions of dollars in student loans for millions of borrowers. And again, right now they're the largest that's out there. And so a lot of the information and the editing that went in today's slides was all helped by a lot of the Nelnet folks who work with me and who assisted me. So that's who we are. And again, that's really where the information for today came from. We have a lot of people really on the ground in DC working with borrowers every day, working with the Department of Education and the Federal Student Aid Office on a regular basis. So that's who I am. As we think about student loans, I think it's important to maybe start at the top and the really big picture because not everyone is maybe super familiar with student loans and with, what they are and how prevalent they are, right? So as we think about student loan debt, the most current number that I found was 1.77 trillion in student loan debt. So for me, that number can be kind of hard to understand. It's the second highest debt within the United States, second only to mortgages. So as much as you hear about credit card debt and auto loan debt and those sorts of things, student loan debt is actually greater than those. It's the second highest debt that we have. The average borrower has a balance of right around $42,000 is what they owe. And that affects, 40 million plus Americans. So we're talking about a big issue here. So even if it doesn't necessarily affect you, you likely know someone who has student loan debt and who's doing these things. And when we think about that 1.77 trillion, most of that is federal student loan debt. And what we mean by that is that the borrower, the student, or their parent in some cases, took that loan out directly with the federal government, and that's who owns their debt. So when you hear about servicers, you hear about Nelnet or Mohila, they are, for the most part, federal student loan servicers. The federal government actually owns the debt. So 8% is private, which, isn't a huge percentage, but when you think about 1.77 trillion, 8% is a pretty big number. So there's a big private student loan market, but it's really dominated by federal student loans. And about, like I said, excuse me, about 92% of the student loan debt that's out there is federal student loan debt. So that's kind of again a real high level on student loan debt. I want to maybe cover some of the key events that have happened, and we'll kind of go back to 2020 and the beginning of the COVID era and what has happened with student loans. And we'll kind of go right up to the beginning of the Trump administration, the 2025 Trump administration. And then we'll start, so we'll kind of cover 5 years, and then we'll really just cover the last few months and the significant events there. So in our world, in the benefit ed world, when the CARES Act came around and it made all of the changes to student loans and a number of other things with COVID, one of the key things that it did is it made student loan benefits tax-free as part of Section 127. We're going to cover Section 127 and some of the current proposed changes here in a few minutes, but that was a significant event. It was the first time ever that employer contributions to student loans could be tax-free. Before that, employers could contribute from a tuition reimbursement point of view, but they couldn't contribute directly to employee student loans as a tax-free benefit. So that happened in 2020. The other thing that happened, as most of you know, is that student loans kind of went into this holding pattern in 2020. They were all on an administrative forbearance, all of the federal loans, they were all at 0% interest. So no one's loans were growing at that time, kind of during COVID. And we kind of went through this, kind of dance many times on the road to repayment, right? So it was extended 7 different times. So people, you'd see headlines, hey, get ready to pay your student loans again, and then it would get extended. So it got extended 7 times. in September of 2023 is when loans actually started to accrue interest again, and people started making regular payments again in October of 2023. So we're not even 2 years from that of of employees, your employees, employees of your clients who have actually started to repay their student loans. It's been, and as we're going to talk about, there's been a bunch of other stuff that has happened as well. So it was less than 2 years ago that loans actually went back into repayment. Okay, the Secure Act happened during that time, which is important from a number of perspectives. It was really a retirement act and really changes to the retirement program, but where it concerns student loans is it was the first time that employers have been able to really incorporate student loans into their retirement plan. And we'll talk about that a little bit later as well. But that was actually signed into law at the end of 2022, and the student loan matching clause in that was effective for plan years starting last year. So last year, 2024, was the first year that employers could implement the matching portion of that bill. And then maybe something that could get lost in the weeds, but I think is really important for people who are following student loans and student loan benefits to understand is the STOP Act. So what the STOP Act did, so it was the Stop Student Debt Relief Scams. It was passed by Congress. It was signed into law. So without going too far down this rabbit hole, you had a lot of what people would call bad actors in not necessarily the student loan benefit space, but in the student loan space. And they would advertise and they would work with borrowers, and they would go to borrowers and they'd say, hey, you pay us $500 and we're going to help you lower your payments substantially. But really what they were doing is they were just helping that borrower access services that were free to them through their federal student loan servicer. So borrowers and employees were paying third parties and sometimes an exorbitant amount of money to access services that they already had access to and they had access to for free. And so the federal government and Congress said, hey, we got to stop these bad actors from taking advantage of student loan borrowers. And so they passed this act. So that was the intended part and the good part. The other part that's really important, and again, really what I wanted to point out from a student loan benefit perspective, is that what it did is it cut off access to any third party as far as access to student loan data. So a lot of people, Benefit Ed and all of the others in the industry, and maybe others that are kind of pseudo in this industry, they could, through different technology platforms, access employees' student loan debt and have all of the data, the amount of their debt, the interest rate, their payment history, all of those sorts of things. Most commonly, that was done through tools like Plaid that you might be familiar with, where an employee would actually log into their student loan in a little window, and that gave the person on the other end access to their data. Okay, so you can see how this would be helpful in helping employees and supporting with their loan, helping verify payments for Secure 2.0, helping make payments from an employer. All of that is gone, and it's still gone. And, to be honest, it's kind of that thing in the industry that is holding a lot of people back from being able to really expand and scale their student loan benefits. And especially when you think of, oh, excuse me, the Secure 2.0 side of things. I got my slides off here, sorry. Go back one, especially when you think of the Secure 2.0 side, there's not really a way for a third party to be able to verify an employee student loan debt on their own, right? Self-certification is allowed. And again, we're going to talk about Secure 2.0 more in just a little bit. But I think that's important for people to understand is that no third parties have direct access to student data. So that's a lot of what happened from COVID until the CARES Act. And I want to talk about some of the more recent stuff right now. So we've got a little bit of a timeline here. Toward the end of the Biden administration, the SAVE plan was introduced and employees began to sign up for it. So this was a brand new income-based or income-driven repayment program that was going to lower the amount of your income that you had to pay towards your student loan. It was going to help a lot of borrowers lower their payments. The administration did it executively through the rulemaking that they have in the Higher Education Act. But immediately there was injunctions and it was tied up in the courts. And if we kind of fast forward to today, it's still technically there, but it's challenged in the courts, and it really looks like it's not really going to go anywhere. Something, there was 8 million people that enrolled in that, and they're all kind of on hold at this point. So you kind of just think about all these administrative forbearances, changes in repayment plans, and we're not done yet. We're going to talk about kind of what's been proposed and what's going to happen, but just a ton of confusion about for borrowers about what's allowed and what sort of repayment plan options they might have. Okay. And then the what's called the USDS servicing contract went into place. So you had a lot of new servicers, but some old, like Nelnet, who was a servicer under the old contract, they're a servicer under the new contract. You also had a number of new servicers, and then you had servicers that went away. So if you recognize the name FIA, for example, the Pennsylvania Higher Education Authority, places like that, there were legacy student loan servicers, they're no more. And so what happened was that millions and millions of borrowers had their student loan account transferred to a new servicer, and sometimes had to get a new account number and pretty much always a new login. And so you think about all of these repayment plan changes that have happened, and then I'm getting new servicers in it, and I don't know what I filled out with this servicer or this servicer. And you can really start to maybe understand, some of the confusion that's out there. So those new servicers went into effect in 2024. I would say for the most part, we've seen the majority of the loans that are going to move, we've seen them move, and most loans are now pretty stable with the servicer they're at, and we would expect that to continue. So we think that a lot of the kind of loan transferring from millions at a time is really over. But there could still be some residual, but for the most part, a lot of the big stuff is really over. Okay. Now you're really into the Trump administration. And as you know, there's been a flurry of announcements and things that have happened, right? So you look back in March and there was an announcement that student loans were moving to the Small Business Administration from the Department of Education. And, that was kind of a big news for a few days, and then it was kind of a non-event. It seems like in reality, that's probably not going to happen. It really wasn't planned for. There's really not a way legislatively to easily make that happen. So things like that have happened. And then the big thing that happened in April was that it was announced that in May, people who were in default, they were going to start having collection efforts restart and happen. So that's the Treasury Offset Program and the administrative wage garnishment. So those two things were announced, and they actually did happen starting in May. So that's been a big change for borrowers. And if you kind of think about that, that is going to be a pain point for a lot of people. And it's also going to cause a lot of credit issues for a lot of borrowers. So those are a couple of things that are affecting borrowers on a regular basis at this point, with credit issues, and then just the pain point of having collections start for them. And then we get into uh, the name, the one big beautiful bill, right? And so that was announced in May, and it's currently with the Senate. So it did pass the House. It's a reconciliation bill, meaning that they can make some changes and they can pass the bill, basically going around a filibuster and the things that might happen there. So that was announced. It did pass the House, and now it's with the Senate. So in a minute, we're going to start talking about some of the proposed changes. And when I say proposed, what that really means is that it has passed the House and now it's with the Senate. Okay. And then one of these post default collection efforts here in June was then kind of walked back by the administrations. So as recently as last week, they said, okay, if you're getting Social Security and you've got payments through Social Security and you're defaulted on your student loans, we're not actually going to garnish those wages. We've kind of walked back that for the time being. As you know, different things could easily change. So that's a lot of kind of what's been happening with things. And again, I would just reiterate that if you're a student loan borrower over the last 5 years, there's been a lot of confusion, probably is the best word, and a lot of trying to figure out where my loan's going, what repayment plans are available to me, all of those sorts of things. So, um, you know, uh, at least on my part, there's some empathy there for borrowers and the confusion that they might have about what they can and cannot do, where their loan's at, how they repay it, when they have to repay it, all of those sorts of things. So again, I'll just pause for a second here and mention that if you want to put any questions in the meeting chat, you're welcome to do that. And we've got a team that will respond to them in pretty real time. And then we will have some time here shortly to chat about any of these things and have people come off of mute. So, all right. So what I want to dive into next is some of the changes that have been proposed. So again, these are proposed changes to student loans. I want to be really, really clear about that. This is not law yet. Some news came out this morning. I was reading a couple articles that the Senate Education Committee also has kind of unveiled their plan, and it looks really similar. So there's probably going to be some tweaks to what the House passed, but it looks like for the most part, when it comes to a lot of this stuff, they appear to be mostly on the same page. And so I think if so again, want to be really clear, these are proposed changes. This is not in effect, but it is looking more and more likely every day that these changes, or a lot of them, actually will take place and will go into law later this year. Okay, so there are some very, very significant repayment plan changes to what's available to borrowers to repay their federal student loans. And again, I probably should have clarified that. A lot of these things I'm talking about, they really deal pretty much primarily with federal student loans, and that 8% of loans that are private are not necessarily as affected by these sorts of things. This is really that 92%, and millions and millions of borrowers who have that. So overall, with these changes, there's going to be a vast reduction in the available repayment plans. It appears there's some grandfathering for current borrowers, but if you're a new borrower, newly into college, newly borrowing federal dollars after this law passed, you're really going to have two plan options available to you, right? So there's a whole bunch of income driven and income based repayment plans right now. You've got ICR, the pay, the save, the IBR plan. Those are all going to be gone. You're really going to have two options. One option is what's going to be called the standard repayment plan. It's going to look a lot like a mortgage. You're going to choose a term that you want. So 10 to 30 years. And your servicer is going to give you monthly payments based on your interest rate and the amount you owe. And it's going to look a lot like a lot like a mortgage that you're going to choose a term for and you're going to pay. And then going forward, there's just going to be a single income driven repayment plan for future borrowers. It's called the Repayment Assistance Plan, or the RAP. And really it says, okay, you make this much, this is your AGI, this percentage of it is going to be the payment that you have to make. There is going to be no $0 payment available in that. So right now there's a lot of people who don't have any student loan payment. The minimum is going to be $10, so $120 a year that every borrower would have to pay, even if they're making, the lowest amount. One of the interesting things and one of the complaints about student loans in general is that if I'm on an income-based or an income-driven repayment plan, my monthly payment is based on my income, but my interest rate's not changing. And so in a lot of cases, I'm paying the amount that my plan says I have to, and I'm in good standing on my loan, but my loan balance is actually climbing and going up. That is taken care of in this proposed legislation. So if I owe $75 a month, but my income-based repayment plan says I can only pay $50 a month, then that other 25 is basically going to be wiped off. And so borrowers will see their loans go down, even when they're on an income-based repayment plan. And the way those work is that after 30 years, the remainder of your loan will be forgiven. So the people who want to do income driven or income based will make those payments for 30 years, a lot like a mortgage, and then they will have the rest of it forgiven. So there's some limitations on moving between plans once you enroll, and there's some changes in what's available to you as far as deferment and forbearance. So, with that, plus the borrowing changes, I would just share, this is my own opinion, and I think others share it as well, is that you will see an increase in private student loans because the amount you can borrow federally and your options for repayment are a little more limited with some of these changes. So the borrowing changes, right? So what as a new freshman going into college or a grad student, what can I actually borrow? Those are going to change. There will be no more subsidized loans. So all loans would accrue interest from the time they're given. So a subsidized loan is really where I take it out my freshman year. It's subsidized, so it doesn't grow while I'm in school. So I don't have it growing when I'm not in repayment. That's going to go away. Grad plus loans are going to go away, and there's going to be new limits on pretty much everything. So including undergrad limits with a $50,000 a year cap, which we know there's a lot of schools that's not going to cover everything that someone needs. So again, these are proposed changes in the current reconciliation bill. All right. I think I got pretty much all of that. Um, what I want to dive into now is section 127. So that's where our primary knowledge is as benefit ed. A lot of people are familiar with education benefits. They're familiar with tuition reimbursement and student loan repayment is now tax-free. But to kind of back up a little bit, Section 127 was introduced into the Internal Revenue Code in 1978. So it allowed employers for the first time in 1978 to assist employees with their education expenses. The amount in 1978 was $5,250, which is the same amount that it is here in 2025. And we're going to talk a little bit more about that. But obviously, as you would assume, in 1978, $5,250 went a long way from an education and getting a bachelor's or a master's degree. And it doesn't quite go as far these days. So originally, it was applicable to tuition reimbursement. That was the mode in which employers used it. So an employee goes back to school, they reimburse them for their expenses. And then, as we mentioned, student loans were added to Section 127 in 2020. Couple of things that I want to mention in addition about Section 127 plans. So these are non-ERISA plans. So Section 127 is not part of ERISA. So I'm not an ERISA guy. I don't know a lot about it. I think I could maybe tell you what it stands for if you pressed me. But ultimately, what I do know is that ERISA comes with a lot of compliance type rules. So those are not attached to education benefits, which is one of the really nice things. It's a pretty simple code section as far as what you need to do as an employer to be able to take advantage of the tax-free education assistance to employees. So you have to have a plan document. It says that you don't have to file that plan document with anyone. You don't have to submit it to a governing body. You just have to have it within your records in case the IRS ever asks for it. And then you can't discriminate in favor of owners or in favor of highly compensated employees. But otherwise, you do have the flexibility as an employer to offer this benefit to who you want in the amounts that you want. So we have a lot of clients who offer an education assistance, student loan payment to all of their employees. But we certainly have a lot who offer it to a portion of their employees. And we'll talk about some of the best practices here in just a minute, as far as, putting those types of programs together. But one thing I really want to stress is that you have a lot of flexibility over who you offer it to and how much you offer them when you offer a Section 127 plan. There's a lot of flexibility in that. If you've got a small employer where there's ownership involved of employees, you got to be a little bit careful. And then you really can't say, well, we're just going to offer it only to the highly comped employees, which you may not say that, but that may be, you think about a medical practice who just wants to offer it to the doctors or things like that. Those sorts of things can get you in trouble with the program, but you have a lot of flexibility in even the amounts that you offer and in who you offer it to. So a lot of flexibility there. So let's talk about some of what I would call the really, really exciting changes that are proposed. So again, we're back to the current reconciliation bill that is passed the House and is currently with the Senate, and the changes to Section 127 that are in there. So again, this is proposed, this is not definite. When student loans were added to Section 127, it was originally in the CARES Act for a year, and then it got an extension for 4 more years. So by the letter of the law, the student loan tax-free portion is set to expire at the end of this year. And what this bill does, rather than extend it for another year or 5 years, it makes it permanent. So student loans would be a permanent part of Section 127 and available to employers. And I think, we have a lot of clients that have reached out to us this year. Hey, what's going to happen? What do you expect? What happens if, they don't get extended? And that's a real concern for employers or employers who are thinking about starting a new education benefit. Why would I want to start a new one if it's going to expire? So while, these are proposed changes and nothing's guaranteed until it's signed, I would say, we have a very, very high confidence level that this will be in the final version of the bill and student loan benefits will be permanently extended as a part of Section 127. So when they're part of Section 127, they're a tax-free fringe benefit. So in the weeds, right? A lot of clients ask us, hey, what box on the W-2 does this go in? And where do we need to record it? It's just a tax-free it's a non-taxable or a tax-free fringe benefit. There's not a box for it on the W-2. Again, there's very little you have to do from an administrative perspective. And when we say tax-free, I want to clarify, right? The employer and the employee are not going to pay any payroll taxes, and it's not going to be included in gross income for the employee. So they're not going to pay federal or state taxes on it either. All right. The other piece, again, this is really, I was surprised when I saw it in there. I was excited, but surprised, is that there is an inflation adjustment that is introduced to the amount of education benefit that you can do. So as I mentioned, it's been $5,250 really since 1978. And now it's hopefully, if this passes, it's going to get its first ever adjustment that would begin in 2027. I would say that the bill itself, I've read the text, it's not super clear on the formula and exactly how that happens. But I think those of you in the benefits space are probably pretty familiar with other benefits where the annual amount adjusts on a yearly basis and that gets calculated and announced at some point ahead of time. And I would expect that something very similar would happen here, where there would be an annual adjustment based on inflation data, and we'll see this $5,250 go up, which I think is really important for the future of education benefits. We see an increasing amount of employers who, on the tuition side, they're offering more, right? They just know that $5,250 does not get their employees very far in their education journey. And so they're offering, 10, 15,000 a year as an annual limit. Not all of them. I don't want to act like that's, the norm in the industry, but we certainly do see a lot of it. And, ultimately then, becomes taxable to the employee, or some employers use the working condition fringe benefit to qualify the rest of it, which is something we do for clients as well. But increasing that amount, I believe, is really important to the future of education benefits, because all of these changes that we're talking about, none of them are really addressing the cost of education. So there's no reason to think that, the cost of education is going to go down, or that the student loan burden or debt amongst Americans is going to go down. During COVID with the administrative forbearance, the total loan balance actually did start going down. And then, once that ended, it started going up again. So that, $1.77 trillion number I mentioned is increasing on a monthly, quarterly, and annual basis at this point. So those are some of the, again, exciting things that are proposed in the current reconciliation bill. Again, more information should be coming out from the Senate, this week. I know I've heard that the goal is that it gets to the president's desk by the 4th of July holiday. I'm not sure how realistic that is, but it definitely feels like some version of this reconciliation bill will get passed and will get signed and will include some pretty substantial changes to the student loan world. Okay, so as we kind of transition from more of the technical aspect of Section 127 and those benefits, why do employers offer these? What's the big deal? Why do we help employees, right? So some employers are looking at it as, we want you to be able to move on to other financial priorities you have. We know that a lot of millennials don't have retirement accounts. We know that a lot of our employees aren't able to, afford a down payment on a home and to get into, home ownership. We know that that monthly payment of student loans is a burdensome number at, nearly $400 a month. And we know that it's long term, right? So I would imagine, this 39% number, if these changes go through, we're going to see that percentage go down of the people who say, oh, yeah, I'm going to be done with my student loan debt in 10 years or fewer. That's going to go down. And student loan debt is going to, become even more of a long-term burden for people than it already is, getting to choose a term between 10 and 30 years, or, paying the income-driven way for 30 years. Just a couple more things, and then we'll go ahead and break and have plenty of time for questions. As an employer or as a benefits advisor or broker, as you kind of think about best practices in the education benefits world, there's a lot of them. I wanted to try to hit on two of them, fairly concisely. But the biggest one I would say is that as an employer, you want to align your policy with your goals, right? So there's certainly, hey, what is everyone else in the industry doing? What does, my broker tell me other employers are doing? What does my provider tell me other employers are doing? But ultimately, you should be aligning it with your goals, right? This should be a win-win where the employee is getting help with their student loans, or going back to school through tuition reimbursement, but you're winning as an employer. That's really how we try to talk to clients. And so when you think about that, what is the tenure, that's really important to you? For example, hey, we know that once you hit 2 years, you're a lot more likely to stay with our organization and become a productive employee, right? So maybe we'll give them a small contribution in those first 24 months. And then once you get over that 2 years, we know that you're, again, productive, you're likely to stay. We're going to increase that contribution. And that kind of gets to the third bullet point of tier your contributions, right? It probably there are some employers where it makes sense to offer the same amount to every employee, but there's a lot where that doesn't make any sense, right? Why would I, help an employee who started 3 months ago with the same contribution as this employee's been with me for 8 years and is highly productive? So tier those contributions, and then, track that ROI. I know that, turnover cost is subjective and squishy, and it's not always easy to kind of get there. But the data, whether it's Benefit Ed's data or anyone else's, it clearly shows that the employees who are participating in the education benefit of their employer are turning over at significantly lower rates than the other employees. That's not to take all the credit or say this is a silver bullet or anything of that nature, but the data is clear. As we look client after client, and that's data that we, help provide to our clients is, hey, it looks like your total turnover of all of your employees looks like it's about this much per month or per year. And the employees who have an account where they're getting education benefits, they're turning over at this much lower percentage. So track that ROI. That's going to help it become a benefit that you're ready to support for the long term. And I think the second thing is, we went through in the first, half hour of all the things that have gone on in the student loan world, right? Employees don't need another complicated thing to navigate, right? Make it simple and easy to navigate. A clear and concise policy document. Don't overcomplicate it, aligning with your goals, but don't overcomplicate it. Ensure the approval processes are easy to navigate. And then kind of remember that there are some employees where they could benefit from both tuition reimbursement and student loan repayment. Those who maybe got debt but didn't finish their degree, or maybe those who are going for another degree. So there's certainly that group, but for the most part, having a tuition reimbursement benefit and having a student loan repayment benefit are going to affect different populations. So you really want to think about how I can or cannot navigate both as an employee, and how I might, take advantage, or what I need to know as an employee, and to make that really clear and easy for employees to navigate, so that, yep, if you want to take advantage of both, I think what we see maybe as something pretty smart is that it's like, yep, if you want to use both, you can go ahead and use both for your employer, but we've got that annual cap of $5,250, soon to go up, exciting. But we've got that annual cap of $5,250, and you can use up to that amount. And so that's where the coordination between the two becomes really important, so that you can really look and see that someone is when they're maxing out and getting to that if they're using education benefits in a couple of different places. So those are a couple of best practices to kind of think about. But really, it doesn't have to be a complicated thing. It doesn't have to be a huge burden on the employer or on the employee, but it can have some really good ROI. We see a lot of employers as well that want to maybe start small. It's like, gosh, I've got, hundreds or thousands of employees, and it seems like a huge budget item. Well, let's find where the pain points are and really target those first and see if we can run a successful pilot program that can show you the ROI, and that this can be a valuable benefit, or maybe that it's not. And then you've spent a little bit of money in a pilot, but you're kind of moving on from there. So if you kind of think about a little more holistically what employers are doing in the education benefit space, right? So we've talked a lot about these two, right? Employers are helping pay student loans through Section 127. Employers are offering tuition reimbursement through Section 127. The other things you'll see out there are Secure 2.0. We've talked a little bit about it. I'm going to hit it real quick as we kind of wrap things up here on the last slide. Support solutions are out there. One thing I just want to be transparent about with support solutions is that stop act, right? So the third party, the benefit ed, the whoever else that you're working with, they don't have access in a scalable, automated way to know employees, what their loan balance is, all that kind of stuff. So that's just something to know with those support solutions. There certainly may be a place to help people with public service loan forgiveness or to help them with other things with their student loans. But for the most part, that stop act has really hindered a lot of the support solution availability that's out there. And then you do see a lot of employers that would include 529 college savings plans in their education benefits program. I want to be really clear. 529s are not part of Section 127. So employers cannot make tax-free contributions to those. But a lot of states do have state tax benefits that an employee can access if there's contributions to their 529. A lot of states where I'm at in Nebraska were just allowed that to go toward K-12 education. So I could start to use it on my kids' K-12 education if I'd like to. So 529s are expanding, and there's actually some provisions in the reconciliation bill that would allow federally some more allowable uses of those 529 funds. Secure 2.0 had some conversions to individual retirement accounts. So there's kind of that whole 529 world that we really are just touching on, but just know that for a lot of employers, they do think of that as part of their education benefit strategy, even if it's not directly part of Section 127. And then just want to kind of mention in closing before we get to Q&A, just a couple of other things that are out there, right? So I've mentioned Secure 2.0 and the qualified student loan matching a couple of times, just to dive just a hair deeper, right? So the way this works is that the employee pays their student loan, but then the employer matches to retirement. So really at its best and what it's intended to do is to try to address both things. Hey, employee, we know you can't contribute to retirement because you've got this student loan debt. So you go ahead and pay your student loan debt over here, and we're going to go ahead and match to your retirement over here. And it's meant to really try to give them the best of both worlds. It does require a change by the plan sponsor to the retirement plan. So it does have to be incorporated by the plan sponsor actually into the program. And it has a little bit less flexibility than Section 127, right? If they're eligible for retirement, they are eligible for the qualified student loan matching provision if you offer it as an employer. So, the Secure 2.0 is great. I think it will continue to kind of slowly grow over time. Last year was the first year. I would say it's been a little bit slow. Couple reasons for that, probably. There was 92 provisions in Secure 2.0. Even though this was exciting to people in the student loan industry, it probably wasn't the most important thing to the people in the retirement industry. And then the second thing would just be it takes more coordination, right? You think of all of the softwares and systems and enrollments that you have for retirement and integrating a student loan piece in that. A lot of plans, if there's not an employee deferral to the retirement, there is no employer match, right? And now you've got this employee payment to the student loan that qualifies you. So you just everyone's got to work together on the benefits side, on the retirement side, in order to make that a priority. But we are starting to see more and more clients interested in that. And then maybe an indicator of kind of what's on the horizon. One thing I'll mention, there was a private letter ruling in 2024. So a private letter ruling means that a specific entity, some corporation, wrote a letter to the IRS and they said, hey, here's what we want to do. We don't necessarily know if this is or isn't allowed. We'd like your blessing to be able to do it. And the IRS writes them back in a private letter ruling, and they usually publish a more anonymized version of that. So we don't necessarily know who the taxpayer is, but we know what they said. So it is a private letter ruling, meaning it's not clear in statute and it's not necessarily to be relied upon. Some employers are comfortable with, hey, there's a private letter ruling out there. We're structuring it the same. We're comfortable going ahead and doing that. Others would say, hey, let's wait for statute and guidance from the IRS to kind of catch up with that, right? But basically, what this does is this employer said, hey, we want to give employees employer dollars, a small bucket of dollars, and we want them to choose between a defined contribution to retirement, HRA, so a health reimbursement arrangement, HSA, a health savings account, or their student loans. So as an employee, I have these different options and I can kind of choose what is the best use of those dollars for me between those. I think, the key parts of this are that these are all pre-tax benefits and this was employer dollars. And so you might be imagining for yourself or your clients, some version of this, but it seems like this is where things are going. This was not part of a regular cafeteria plan that might already be approved and in statute. This was something new and different, but it really allows kind of that choice and the ability for an employer to say, hey, here's some dollars, here's some different tax-free options, and you get to choose how you want to assign them. Probably the challenge here from an implementation and an operations perspective is a lot like the Secure 2.0 side. Everyone's got to get on the same page, right? It's probably someone different who's helping you facilitate the contribution to the retirement versus the HRA versus the HSA versus the student loan side. So there's really an operational, maybe some logistics to figure out there and trying to find someone who can say, okay, each employee gets $3,000 and we got to track how they're allotting it and get the money there. So those are just a couple of other kind of exciting things that are happening. I think student loan benefits will continue to be on the forefront as we kind of think about, again, that journey the borrowers have been on. They're just starting to see collection efforts. They're just starting to try to figure out some of these new repayment plans. I think that pain that employees feel is going to continue to bubble up to employers and is going to be an issue that employers are going to continue to hear about from their employees. And leading more and more employers to wanting to address it. And as you heard today, there's a lot of different ways that they might be able to do that. So kind of with that, I am going to take a drink of water and we're going to open it up for questions. So if you are more comfortable with putting your questions in the chat, that's great. If you're more comfortable addressing your questions specifically within Zoom to myself or to Bill on my team who's helping or to Tanner, you can do that. Or if you say, hey, I'm going to unmute, I'm not afraid, I'm going to ask you a question, you can feel free to do that too. Think we've got just a couple of things that we can kick the Q&A off with. But again, feel free to raise your hand, unmute yourself, whatever you'd like, or put something into the chat. So for a lot of our clients, question number one right now is, hey, will student loan benefits be tax-free after this year? So, the short answer to that, I gave you the long answer already, but the short, concise answer is likely, but not yet. And we should know more in the next 30 days or so. So if, clients are asking about that, as well as clients who might be asking or employers who might be considering a new benefit and they feel hesitant because of that expiration, I would say it feels very, very likely that that will be permanently extended. Not definitive, but very, very likely. Uh, I mentioned the 529 changes. Um, so some of those 529 changes are just more allowable expenses. But the way 529s work is that federal statute says, okay, these are all qualifying expenditures from 529, but then states have to adopt those. So it could be a little while before those make it down to the actual account holder. Any, any questions from the group or anyone that wants to be a brave soul and unmute themselves and ask anything? All right, I've got a couple of other questions. The current legislation, I do believe that some version of the bill will pass. There's not necessarily bipartisan support, but with the reconciliation process, there doesn't necessarily have to be. So I would expect, some version of this bill to pass and a lot of these changes to really happen in the student loan world. And think something that a lot of people wonder about with these programs is, what does compliance look like or reporting requirements, right? And so maybe just to reiterate, this is a non-ERISA benefit, so it does not fall into, a 5,500 filing or anything similar. You really have to have a policy, and they're not overcomplicated, right? We have templates. Most providers have templates that they can provide to an employer and that they can use. And you don't file it with anyone. You don't file any annual reports. And certainly, the IRS could come and ask. I think that's pretty low risk at this point with everything else going on. But definitely, could. Um, another good question that came in is, does the bill address any non-traditional education options, apprenticeships, certifications, online programs? It doesn't, to my knowledge, address anything of that nature. Really what Section 127 says is it says, um, that education assistance doesn't include payment for things that would be considered sports, games, or hobbies. But that doesn't mean that your tuition reimbursement program has to be used only for degree seeking programs. If someone wants to go get a certificate or a one-off professional development class, those things can most certainly be used in that space for sure. And then, probably the last question that I have so far that's been submitted is, anything that HR leaders or benefit managers, benefit brokers, what should they be doing today to prepare for, these changes in legislation, right? So, number one on the Section 127 piece, if it's permanently extended, if the amount's going to go up, I think that's only going to mean that this becomes no longer a thing that kind of started and is there a little bit, but might die off, right? It's not going to die off. It's going to continue to grow. More and more employers are adopting them now. Maybe at different rates, different years, but I'll tell you that our client retention is incredibly high, and I don't mean that from a braggy point of view. I mean that from these programs are sticky. Most of the time, when employers implement them, they are not then discontinuing them. So they are only going to grow and increase in popularity as the tax-free status is no longer an issue and it's permanent, and the amount continues to go up. I think is what we'll see. And then, I think the other big thing is generally just be ready to have that empathy and support employees as they, navigate even more changes to the student loan landscape. After everything they've been through maybe the last 5 years, and now some pretty big changes to what sorts of repayment programs they can enter into, and the terms and the length and duration with which they're going to be paying back their students. So, um, any other questions that folks may have or things that they want to talk about? Well, it's about 5 till. I certainly will stick around if people want to. Feel free to reach out. My email is here, and I'm happy to have a conversation about any of these items. Any questions that may come up, or presentations to your team or presentations to clients or anything like that, happy to do something very similar to this, or maybe a shortened version. If you'd like to educate everyone about kind of what's going on in the student loan space, and more specifically the student loan benefits space. So again, I'll stick around if anyone has other things that they'd like to talk about, but otherwise, I really appreciate you coming and your attention and your participation for today. And hopefully you have a great rest of your Wednesday.